Hello, everybody. Thank you for listening to our quarterly market and investment policy update. I'm Adrian Cronje, and also joining this webinar today is our Director of Research, Gabe Lembeck. This is our first virtual quarterly update. We hope to make it a regular quarterly occurrence in the future. Today, we are going to bring you up to date with our thinking, including reviewing the first quarter of the year. Even though we have to acknowledge that the 31st of March seems like a decade ago, given all the water that has passed under the bridge since then. Gabe is also going to be talking through some charts to illustrate several key points we would like for you to take away from today's session. And then we will turn our attention to the central question, lingering for most people. And that is, what does the road to recovery look like? We've obviously been drawn into lots of conversations around that here at Balentine. Not just about investments, financial planning, and the economic outlook. As our chairman, Robert Balentine, outlined in his recent video update, available on our website, we are not all in the same boat, even if we are in the same store. So let's start with a quick review of the first quarter. The US economy was firing on all cylinders as we entered 2020, as measured by gains on Wall Street, and more importantly, through Main Street successes, including small business profits and employee wage gains. As we all know, the momentum was derailed by a black swan event in the form of a global health pandemic, the coronavirus COVID-19 pandemic, which by itself was significant enough to force governments to shut down economies to prevent the virus from overwhelming the global healthcare system. And to make matters worse, a historic crash in the oil price exacerbated fallout from this health crisis. The oil price collapse is perhaps unlike any other asset decline in history. Prices even turned negative for a short period last week, as the combination of a demand breakdown and a positive supply shock inundated the world in oil, to the point at which owners actually paid investors to take crude stock off their hands, rather than paying short-term storage costs. From mid-February through late March, the US stock market fell 35% peak to trough. This represents the quickest decline of such magnitude in market history, including the monumental drops of 1929 and 1987. As a reminder, throughout the crisis, our advice has been as follows. Firstly, we remain committed to following our model discipline and maintaining existing positions. This approach allowed us to avoid permanently impairing capital by reacting emotionally during the market panic, and it has allowed us to participate on the upside given the subsequent market rebound. The extraordinary levels of high volatility have clearly subsided, now permitting us to assess expected returns and risks thoughtfully and unemotionally through the prism of our models. Secondly, to enhance liquidity across investment programs. We advised our clients to shore up cash on hand and access to credit lines to meet their spending needs for the next 2 years to bridge the gap from today's highly uncertain outlook to the brighter long-term days ahead. And thirdly, we tax loss harvested taxable accounts very aggressively, harvesting losses in our strategies and swapping into comparable assets without compromising a portfolio's ability to participate in any rebound. But perhaps the most unusual thing about equity price action over the last 2 months may be the staggering extent to which the market has rallied since March the 23rd. The S&P 500's ascension since then, 31% off the low at its peak, suggests the stock market believes the worst of the coronavirus impact may be behind us as economies slowly begin to reopen. With that said, as we will touch on in our outlook, certain areas remain vulnerable to negative ripple effects. While credit spreads have not approached anywhere near the levels we saw in the recessions of 2002 and 2008, they remain elevated, especially so in certain areas and industries that may experience knock-on contagion effects. The real question is how much of this stress will remain in these sectors and industry groups most affected, such as financials, retail, travel and hospitality, restaurants. In addition to that, the energy sector, and of course, we all need to keep an eye on the emerging world outside of the developed world for potential effects of contagion. The economy and stock market today appear to be disconnected. Many have wondered why the equity market, which is now down merely 15% from its peak, can be there in suspense while the economy seems to be in despair. With the current unemployment situation as reported last Friday in May's payroll reports and forthcoming GDP figures likely to echo those readings last seen during the Great Depression. Capital markets, for example, the stock market, the bond market, the credit market, and the commodity markets are forward-looking, leading the economy by 12 to 18 months. So they will provide us clues as to the likely shape of the recovery. Thus, the equity revival over the last month could suggest that a combination of aggressive and unprecedented monetary and fiscal policy has permanently taken the worst-case scenario off the table, even if a V-shaped recovery may not be on the cards. On the other hand, we need to acknowledge that lingering economic damage and current prices when considering upcoming earnings and dividend cuts could suggest that the equity markets today may be being too optimistic about a likely recovery. After all, bear markets associated with a recession usually last more than 5 weeks. We expect market volatility to remain elevated over the next 6 months, even after the tremendous resurgence in equity markets during the month of April, and we will tackle the outlook in detail in a moment or two. We also think interest rates are likely to stay low, given the response of both the bond market and the Federal Reserve to short-term deflationary headwinds. Dividends are likely to be cut as companies hoard cash to weather the storm until the economy works its way back to some semblance of normality. In the current environment, there is an overwhelming temptation to chase yield in search of income. We advise investors to resist the temptation, since that pursuit comes at the expense of thoughtful consideration of credit and solvency risks, which typically accompany increased yields. Although it is unlikely the economic and financial stresses will be as bad as those experienced during the global financial crisis, structural impairments in certain stressed areas of the economy will take time to play out. There has been understandable stress in the municipal bond market, particularly around the likelihood of reduced revenue from sales and property taxes, which may result in financial pressure. The possibility of such credit concerns in normal times, much less during exceedingly stressful times, is exactly why we favor high-quality active managers in this asset class. We are encouraged by the actions taken by the Federal Reserve to stave off systemic issues in this sector. We do, however, acknowledge the likelihood of idiosyncratic problems around some of the municipalities with weaker balance sheets, barring a quick resurgence in the economy. This further reiterates the idea of not blindly chasing yield and focusing on a return of capital rather than a return on capital when investing in fixed income. You know, it's worth taking one step back and acknowledging the shock and awe response from the Federal Reserve in order to provide liquidity so that markets could continue to function during the violent capital market dislocations in March. The Federal Reserve has definitely learned from its reactive, slow, and incoherent policy response to the 2008 and 2009 financial crisis, and have been decisive, using all their weapons at their disposal during the coronavirus crisis. Just take a look at all the actions they have announced so far. It really is remarkable. I personally never thought I would see the day where a Fed chairman testified to Congress about the possibility of buying corporate bonds and backstopping the municipal bond market. It is also important to bear in mind two things. Firstly, the Fed is a lender of last resort, but not the spender of last resort. There are limits to what the Fed can do to cushion the economic fallout, given that interest rates are now so close to 0%. The onus is increasingly on fiscal policy in order to smooth the road to recovery. Secondly, the long-term consequences and potential currency debasement from so much money being created is part of the reason why our model discipline, based on momentum, has picked up on the opportunity to allocate to gold bullion in the current environment, an investment policy change we will talk about in greater detail later on. And now I'd like to turn our attention to our Director of Research, Gabe Lembeck. Gabe will walk us through some market observations from the investment strategy team that reinforces several of these key points. Gabe?
Thank you, Adrian. This chart shows major declines for the S&P 500 over the last 35 years. The declines encompass the 1987 Black Monday crash, the 1990 recession, the 1998 Asian currency crisis, the 2000 bursting of the internet bubble, the 2007 onset of the global financial crisis, and the December 2018 crash on concerns about premature tightening of monetary policy. What we can see is that the decline from February 19th to March 23rd was by far the fastest decline of the bunch, and moreover, the swiftest decline since the Great Depression. This feels like the market movements of 1987 coupled with the shock of 9/11. What really is remarkable is not that we went from peak to trough in such a short period of time, but that we recovered so many of the losses so quickly. Historically, faster declines resolve themselves more quickly. This one has proven to be no different. As breathtaking as the decline was, the increase since March 23rd may be even more so, spurred on initially by aggressive monetary policy and fiscal policy, and spurred on lately by optimism on the economy reopening and progress on the medical front. At the bottom, equity prices were pricing in the grimmest of economic scenarios, which were never likely to come to pass sustainably. The rebound has been predicated on both the economy beginning to open up more quickly than anticipated, as well as advances on the medical front earlier than anticipated. As is customary, we want to walk you through quarterly returns, but just bear in mind, market movements have changed returns, but the general gist has remained intact. Our disciplined approach of emphasizing and de-emphasizing certain asset classes led us to incredibly strong performance within market risk. Obviously, the first quarter was stressful across the board. Aside from gold and bonds, asset prices were hit hard. It is important to note several important points. First, U.S. large cap growth weathered the storm the best, as stronger balance sheets and less impact to top-line demand left people seeking to sell other areas first. On a one-year basis, the category was still positive. Second, because the quarter was snapshotted on March 31st, the subsequent April rebound that is married to the March decline is not in these results. Just like the decline in December of 2018 was cut off from the January 2019 performance by those snapshotting the year end on December 31st. So it is important to look at the subsequent respective rebounds to see which asset classes did the best point to point. Interestingly, many of the classes that underperformed on the way down also underperformed on the way up. For example, they declined more in March and increased by less in April. Third, note the large dispersion, in other words, the large variation in returns among the different indices over the last year and the last 3 years. This is exactly the environment in which our model excels, picking the right areas in which to be. 1, out of international, 2, within domestic, no small cap, and 3, within large cap, a focus on growth stocks. As strong as 2019 was across the board, the first quarter was the opposite. Again, the exceptions being bonds and gold. Within our building blocks, key things to note are as follows. First, yields on cash collapsed as the Fed lowered rates back down to 0. This will impair cash returns moving forward. We expect this condition will remain for the foreseeable future. Second, fixed income returns were strong, but they were not strong across the board, details of which we will touch on in a little bit. 2019 was a banner year for bonds, and then the COVID-19 pandemic accentuated that in the beginning of 2020, as capital sought safe havens among the stressed. This there was tremendous divergence in corporate and municipal bonds as concerns over municipal revenue created unprecedented stress amidst quarantines and forced selling during volatility. While Treasury inflation-protected securities, also known as TIPS, rose 1.7%. Of course, after a strong first half of the quarter, the bottom fell out of the equities market as the COVID-19 pandemic unfolded in unprecedented fashion, resulting, as mentioned earlier, in the fastest bear market correction on record. But fortunately, the areas in which our model put us declined by less. As you can see here, domestic markets outperformed international markets, while within domestic markets, growth strongly outperformed value as the energy and financial sectors within value were disproportionately impacted. In the alternative space, many investors use hedge fund strategies. Those strategies were up because many funds had short positions on the market to offset their long positions. These are the same funds whose short positions led them to lag the market during strong up quarters over the recent years. But during the first quarter, those positions served the funds well. Our use of alternatives is to find different risk and return drivers rather than merely rearranging stocks and bonds in differing long and short positions. Our investments in real estate and real assets held up well under the circumstances and brought diversification to the portfolio. Low returns dispersion in the first quarter was not surprising. In panic situations, there is typically no place to hide. All asset prices decline in tandem as sellers sell everything en masse to raise liquidity, except perhaps only those assets perceived to be the safest of havens, such as US government bonds and sometimes gold. All things considered, our model hid very well. Despite that, our areas outperformed. Since 2019, our market risk model has returned approximately 27%, compared with an increase of 11.5% for ACWI. Importantly, this outperformance has come consistently across both rising markets and falling markets. In other words, in months when the market declined, our positions declined by less than the market, and when the market rose, our positions rose by more than the market. We expect this dispersion to pick up going forward as the market sorts through the likely winners and losers from the coronavirus fallout. We expect this to occur not only at the individual security level, but also at the geographic level and sector level, which should continue to create an environment in which our model discipline is designed for. As mentioned earlier, fixed income as a whole did well during the quarter. However, the yields on municipals went higher as credit risk concerns came into play. This is distinct from non-credit fixed income, which price in only interest rate levels and whose rates declined. So while returns on US Treasuries surged in the wake of the interest rate collapse, returns on fixed income with credit risk struggled as concerns about credit defaults among corporations and municipalities surfaced. It is precisely for this reason that we emphasize only high-quality credits in fixed income. As mentioned earlier, stretching for yield is not appropriate. Maintaining the right amount of liquidity and constraining fixed income to be merely a boring equity ballast provide the line of defense for an exogenous shock, as shown over the last 3 months. Within market risk, we take a look at valuations. This is a chart of the valuation range over the last 10 years. The top of the bar is the highest valuation. The bottom of the bar is the lowest valuation. The orange bar represents the median. The blue dot represents where we were at the beginning of the year. And the black square represents where valuations were at the end of the first quarter. Although equity valuations were not expensive relative to fixed income, they were expensive relative to their own history. The declines in March served to reduce valuations closer to their historical averages. Of course, the market's rebound in April brought valuations higher again. Additionally, as earnings decline and dividend cuts present themselves, valuations will increase further. So, when the uncertainty is removed and these declines play out, it will be crucial to see where the resulting valuations fall out to gauge truly how expensive or inexpensive the market is. Within private capital, where we recommend our qualified clients invest, we believe it's important to consistently allocate and not try to time vintage allocations. We do believe, however, that investors can stay on vintage while still being thoughtful about where they allocate. This is why we are especially excited about our manager Fulcrum and JF Lehman, currently being in the market. Both have track records that date back through previous recessions and have areas of focus that can and have proven to be less cycle dependent. We also believe diversification of equity exposure is important. This is why we are also recommending an allocation to Harvard, a highly active real estate manager that has also invested through multiple cycles. For the majority of time during the recent few years, we have been emphasizing stocks over bonds, which helped our strategies outperform in a strongly rising market last year. Amid record low unemployment, continued earnings growth, tame inflation, abating trade concerns, and the relatively uncompelling case for fixed income, our portfolios were positioned with a significant weighting towards equity markets as the crisis suddenly erupted. Our tactical overweighting of equities during this quarter thus hurt portfolios after the strong outperformance it generated during 2019. However, through our repeatable model-driven process, we have consistently emphasized the right area of global equity markets and avoided the areas that have suffered the worst pain throughout 2019 and 2020, whether markets were rising or falling. Specifically, we emphasized US stocks over international stocks, avoided small cap stocks, and importantly emphasized growth stocks over value stocks within US large cap. The model signal to prioritize growth over value had the further effect of reducing exposure to the energy and financial sectors, which were most disproportionately impacted by the coronavirus crash, all of which resulted in outperformance in both rising markets and falling markets by our ability to identify the right areas in global equity markets and avoid the underperforming areas in a repeatable way. Now I turn it back to you, Adrian, to talk us through the outlook of what lies ahead.
Thank you very much, Gabe. It really is remarkable to reflect on the extraordinary market movements that we've experienced over the last couple of months in particular. You know, we as a team have invested through several bear markets over the last few decades, and I personally think it to be one of the most extraordinary periods of time in capital market history. So as we turn our attention to the long-term outlook, I think it's important for us all to just level set on a couple of key points. And that is, I don't think we should lose sight that real medical progress has been made against the coronavirus pandemic, even if we have not yet crossed the finish line. There are reports of remdesivir being an effective therapy, for example, as well as documented evidence that 7 potential vaccinations are already in human trials. Ultimately, remedies such as these antivirals and vaccines are what is going to solve this global health pandemic. While America's industrious biotechnology and pharmaceutical companies are working hard to solve this problem in double quick time, investors should recognize that in the meantime, the curves for infections, hospitalizations, and fatalities have flattened substantially. In other words, social distancing and putting American business into a great lockdown has worked, avoiding the burden which was projected to overwhelm the healthcare system a few months ago. So even though progress in medical remedies may take a while, the numbers have not yet met the apocalyptic initial projections that resembled the shocking human catastrophe of the Great Spanish Flu in 1918 and 1919. As a result, governments across the world are plotting their courses for reopening their economies, though it is obviously not going to be easy to get things started immediately or even smoothly. Success, of course, will depend on appropriately determining which businesses go back to work first, appropriately regulating those permitted businesses on how to do business, and third, and perhaps most importantly, responsible behavior from individuals going back to work. Herd immunity may also bring some benefits, as increasing evidence points towards a large number of people, many of whom may have been asymptomatic, having already contracted the virus, thus lowering its fatality rate. So with that being said, what does the recovery look like? And here, over the last few weeks, there have been a veritable alphabet soup of prognostications about what the recovery might look like henceforth. There has been talk of a V-shaped recovery. There has been talk of a U-shaped recovery, potentially even a W-shaped recovery where the virus mutates and comes back to be even more infectious during the fall period. And ultimately, as we look ahead to the economy, we will be using the same insights that we have used over the last couple of decades. And that is to use the signals that the stock, bond, credit, and commodity markets send us every day about the likely timing and trajectory of the recovery. And for several weeks now, we have been talking about those messages looking to suggest to us that the recovery is set for a long Nike swoosh type recovery from today through the end of the year, where the economy has gone into free fall during the second quarter, but slowly begins to recover over the ensuing quarters in a stop-start, slow way. In other words, that recovery may not come fully in aggregate, at least until the first quarter of next year. And here there are two competing forces that are worth trying to understand. On the one hand, there is a tailwind for a fast recovery, potentially coming from businesses adopting several game-changing technologies that have been on the horizon for a while to make their businesses more productive. And here I'm not just talking about the Zoom technology and other methods of communication that has allowed us to stay in touch during the great lockdown. I'm really talking about artificial intelligence, alternative data, what automation can do to help our manufacturing sector start perhaps more quickly than the services sector that relies on gathering and sharing, and also potentially the blockchain protocol underlying cryptocurrency. We've talked about that at length at Balentine over the years, but really, as we have had to deal with coping with the crisis, continuing to try to do business in lockdown, there may well be a tailwind from businesses adopting some of these game-changing technologies to make their businesses more productive and perhaps more profitable, which will provide a tailwind for them to continue to employ people. Offsetting that, of course, is the severe headwinds of an economic flywheel that's working in the opposite direction. And that is the flywheel of job creation leading to income growth, leading to spending. And as a reminder to you all, consumer spending is still well over 2/3 of our economy. And of course, as Gabe said during his remarks, that flywheel was working in the right direction and seemed to be picking up pace, particularly during 2019, as the economy continued to set records for the longest ever expansion, and the labor market was enjoying a record period where wage growth finally started to be picking up. As evidenced by Friday's payrolls report, that flywheel is clearly moving in the opposite direction, with a decade's worth of job creation being eradicated overnight. And so the potential for that to undermine income growth and therefore to undermine spending is exactly what policymakers are continuing to look at very closely today. It's for this reason we think that there is a very high likelihood of further fiscal stimulus, which could in turn lead to compelling investment opportunities such as infrastructure investments. And you all will know that we wrote in detail on that topic a couple of weeks ago. After the immediate crisis subsides, we also expect greater attention to be turned to the sustainability of government debt and its consequences for interest rates, inflation, and the US dollar. This global health crisis and the policy response of shock and awe has accelerated decisions we must confront as a society on the unsustainable debt trajectory we have been following really for several years, and especially around the entitlement programs of Social Security, Medicare, and Medicaid as a greater proportion of the population reaches retirement age. We are clearly set for another contentious political cycle this year, but perhaps the most difficult and contentious political cycle may actually be in 2024 on the other side of this crisis, when we all have to make some very, very difficult choices as it relates to how to put the path of debt back on a sustainable path. So the bottom line is, a key takeaway is that stressful dislocations in capital markets generally bring about superior expected returns for globally diversified portfolios over the long run. And as Gabe stressed during his remarks, it's important to focus unemotionally on building a bridge to the other side and getting across that bridge. You saw that very specifically in the chart on valuations that Gabe talked to about where there may be potential above average expected returns once the crisis subsides and the road to recovery is underway. So what does all this mean for investors and to investment policy? Well, I'd like to just reiterate and summarize a few key points. During this unprecedented bout of volatility, the right course of action has been to refrain from panicking, to enhance liquidity across investment programs, and to harvest tax losses aggressively for taxable clients. We continue to remain alert to the potential of gaining exposure to certain areas of the markets that promise outsized long-term returns through the options markets. We continue to encourage clients who have more than 2 years worth of spending needs set aside in cash and short duration fixed income to deploy this dry powder into strategies. This, importantly, will require investors to stay invested for at least 18 months to ride through elevated market volatility over the near term. We think investors should take 6 months to average in, and we recommend starting now. As I said earlier, although the end of this crisis will occur only upon the identification of the effective medical solution to the pandemic, this does not preclude interim positive results from occurring in certain areas of the markets. While equities in aggregate are poised to increase over the long run, much uncertainty remains in the near and medium term. Capital markets lead the economy, not the other way around. We will continue to follow our model discipline and to watch the signals that capital markets send us about the future. And as Gabe said, we will continue to remain highly selective in which areas to emphasize and de-emphasize. And that's because our conclusion is that it remains still too early to play outright offense. In the last month, our models have identified an opportunity to allocate to gold bullion, and I'm going to provide a few details around that in a moment or two. But before I do so, I do want to remind you all that while there are certainly many tempting asset classes which appear to have fallen in price precipitously, in many instances, in our view, those price declines have been warranted. And we do not believe the potential reward justifies the potential risk at this point in time. It's always helpful to remember in this regard that history shows us that bottoming from a shock is a time-consuming process. For example, it took 48 months to recover in 2002 and 37 months in 2009. So given that capital markets are telling us to expect the road to recovery to look like that Nike swoosh sign that I mentioned earlier on, and that in the absence of a game-changing medical therapy or vaccine, I wanted to reiterate our view that the economy, based on what we see today, is not likely to recover broadly until the early part of next year at the earliest. In saying that, it's useful to remember Chairman Robert Balentine's metaphor that we're not in the same boat, even if we are in the same storm. Some industries that rely on the sharing economy, as I mentioned earlier, travel, hospitality, industries such as the energy sector and financials may take a lot longer time to recover than some of the more resilient industries such as technology and healthcare. So as I said a moment ago, we continue to be selective when positioning our global equity exposure, as we do not think that a V-shaped recovery such as 1987 is likely. So I wanted to spend a little bit of time ending off the webinar with bringing you up to date with a change that we made to investment policy over the last few weeks. And that has been our decision to initiate exposure to gold bullion. During peak periods of panic and extraordinary levels of high volatility, our disciplined process allows us to distance ourselves unemotionally from panic selling and panic buying that ensues, and instead allows us to assess expected returns and risks both in the near and long term in an unemotional and disciplined way. And we think that's what gives our investment process an enduring competitive advantage. It is the essence of the repeatability of our decision making. And as a reminder, when allocating between equities and fixed income, our process looks at both relative value and momentum of stocks as compared to bonds. For our model to tell us or lead us to conclude that a significant bear market, as defined by its depth and duration, is on the horizon, our relative value indicators need to signal that the value of equities has reached an extreme level when compared to fixed income. We have been studying our indicators in depth during this crisis. At the end of March, the model suggested stocks were modestly inexpensive relative to bonds. At the end of April, the model actually indicated the same. Furthermore, when we contemplated expected declines in earnings and cuts in dividend payments, it tells us equities are now only slightly expensive. In other words, far from the extreme levels they reached in 2000 and 2008. And so, as Gabe mentioned during his remarks, it is for that reason that we are keeping with our discipline and continue to maintain our overweight to stocks in portfolios today. After addressing how much to allocate to stocks and fixed income across strategies, we then look at our process to guide us to which areas within global equity markets and equity-like investments to emphasize and de-emphasize. And here our insight is predicated on the observation of studying several decades of capital market data and the underappreciated point that cycles and performance dispersion between asset classes occur over extended period of time with a large amplitude, which gives us the opportunity to rebalance proactively, based on momentum indicators, to emphasize areas objectively rather than to try to time investments subjectively. And in the last couple of months, our model picked up on the fact that we are poised on the potential super cycle of gold bullion outperforming equity markets. And it's for that reason that we have initiated exposure to gold bullion, as we communicated with our clients in detail a week or so ago. So as a reminder, we really view this as an offensive opportunity in the portfolio. We think gold bullion will outperform whether the stock market is likely to rise or fall over the next few months. But we are particularly attracted to its potential ability to introduce risk mitigation should there continue to be volatility in the near term. From a qualitative perspective, we think this model-driven decision also makes sense. During a time of financial stress in the system, concerns regarding fiat currencies resurface again as central banks re-engage in currency debasement and take on large amounts of debt to get economies through the coronavirus shutdowns. Recall the slide we showed you earlier on in our presentation of all the steps that the Federal Reserve have taken in order to bring relief to the economy so far. Additionally, although it is highly unlikely that we will see any substantive inflation in aggregate anytime soon, we have to acknowledge that the potential for inflation to present itself at some point in the future, given all the money that has been thrown at the problem, has definitely increased. Given the magnitude of the Fed's balance sheet expansion, there are real issues about the eventuality of long-term inflation. If recovery is slow, debt becomes a much bigger problem, with politicians loath to remove the sticky spending in crisis, which often promotes constituent satisfaction. Moreover, when the recovery is eventually upon us next year, increased currency issuance could begin to spur inflationary velocity inflationary pressure as monetary velocity picks up. For all these reasons, we think gold should do well over at least the next 12 to 18 months. So in closing, we'd like to remind everyone again of all the resources we've made available, and that these are all accessible on our website at www.balentine.com under the Insights section. We recognize that the last 60 days have been a whirlwind for everyone, for investors, for trustees, for businesses, and indeed for families. As part of our commitment to you, we've created a dedicated section of resources and put out content from the many subject matter experts we have on our team, from regular market updates from our investment strategy team to periodic releases on specific areas of interest, such as infrastructure investments, and digging into the details of what the stimulus means and how it applies to businesses. Looking ahead, we want to help you think forward about what is next strategically. What will the world look like 6 months from now? What will it look like a year from now? Eventually, this crisis will subside and this too shall pass. But how do we get to that place? And what happens next? Our webinar series, which we have called The Road to Recovery, is committed to helping you think through all of these issues for your business, for your family. And we will pull in subject matter experts from across our network so that you can hear from them directly about all these issues. So please be on the lookout. And if there is a matter of special interest to you, please let us know by dropping us an email to info@balentine.com. Thank you all very much for listening, and please contact us if there are any points you'd like to discuss. Thank you for your time and indulgence.